Welcome to part 3 of our special report on private lending. Again, we thank you for your time and hope that you get a lot out of this. We'll now get into providing you an overview of what private mortgages are and how they work. It will show you with whom you'll be investing your money and why private mortgages, when done correctly, are some of the safest investments in the world. It will answer many of your questions about private mortgages and show you how you can begin immediately to take control of your financial future. In this report, you'll find the answers to questions like, what is a private mortgage? How much money do I need to have to be a private lender? Who is my borrower? How big is the demand for private mortgages? Why don't these borrowers just go to the bank to borrow money? How much control do I have over the terms of the mortgage? How am I protected from losing money? How much hands-on involvement will I have to have with the property? What if I need my money back before the end of the loan term? How can my retirement plan invest in private mortgages? And how do I get started? Excellent questions. Now for some answers. As to the first question, what is a private mortgage? A private mortgage is simply a loan made by an individual or privately held entity to an individual or privately held entity for the purpose of purchasing, refinancing, or renovating a piece of real estate. If you've never made a private mortgage loan, it might help you to think of yourself as the bank and your borrower as the customer. When your banker makes a mortgage loan, these are the steps he takes. He makes a call to order an appraisal to make sure that the property that will secure the loan is worth as much or more than the amount of the loan. He makes a call to a title agent to order research to make certain that the title to the property is clear. He makes a call to his attorney to order paperwork that documents the terms and conditions of the loan. He sends funds in the amount of the loan to a title company agency or a real estate attorney to complete the transaction. After the closing agent sends him a copy of the recorded mortgage, the promissory note, a lender's title policy, and a copy of the property insurance policy. He sits back and waits for the payments to come in. As you can see, mortgage lending is a completely hands-off transaction for the bank. In fact, your banker never leaves his desk. Creating a mortgage loan is simple, stress-free, and profitable for banks if they use traditional underwriting standards. That's why they've been doing it for centuries. And you'll find that private mortgage lending is the same for you. But you'll also find that you have many advantages over a bank when it comes to investing in mortgages. For one thing, your banker is handcuffed by bank policies, procedures, and rules that make it impossible for him to make certain loans that could be extremely profitable for the bank. Since the banker isn't lending out his own money, in fact it's your money and that of hundreds of other depositors, he has no flexibility to adapt the terms of the loan to the borrower, the property, or the situation. And because the federal government regulates banks so heavily, the banker is obligated to loan money to anyone who meets certain qualifications and obligated to refuse to loan money to those borrowers who don't meet certain criteria, like real estate investors who happen to own more homes than outlined in current regulations, even if that borrower is ready, willing, and able to repay the loan. You, on the other hand, have enormous flexibility in terms of how, when, where, and to whom you make mortgage loans. Since it's your own money you're investing, you can pick and choose the borrowers and the deals that work for you. You can charge more here and less there, depending on how safe you think a deal is. And most importantly, since you're an individual working with an individual, you can negotiate every single term, from the interest rate to the length of the loan, to when the payments are made, to meet your needs and those of your borrower. This gives you a huge advantage over your poor, constrained banker and allows you to make profits he can only dream of. Next question is, how much money do I need to be a private mortgage lender? You don't need to have endless financial resources to be a private lender. There's a demand for private mortgages in amounts as small as 1/10 of the average price of a single-family home. In the Midwest, for example, borrowers commonly need mortgages as small as $10,000 to $20,000. Of course, there's also a demand in the $50,000, $100,000, and $1 million plus range. And the more cash you have to lend, the more options you'll have open to you in terms of the kinds of properties and borrowers you choose. But remember, as a private lender, you choose the loans you make. If you're most comfortable with loaning out smaller amounts of money, that's what you'll do. You are in control. This concludes part 3 of our special report. You are but a click away from part 4.